Statistics Canada. They'll be reporting Canada's August inflation numbers tomorrow. And according to Reuters, there's a group of economists that are expecting the inflation rate could drop as low as 2.1% for the month of August. That would be its lowest point since March of 2021. If that is accurate, that's a pretty significant drop from the 2.5% rate that we saw in July. The biggest reason for this projected cooling is the dropping in gas prices. But even with that, we're seeing core inflation measures also expected to decline. Now, the Bank of Canada has been cutting rates pretty steadily now in response to the falling inflation. It's lowered its key rate by a quarter point earlier this month to 4.25. Again, the third cut in a row there. Now, Governor Tiff Macklem, he said that further cuts could be on the agenda if inflation slows faster than expected. Here's what he had to say on the topic.
Good morning, Governor. I'm wondering if anybody around the table argued for a half-point rate cut, or whether that was something that you debated.
There was a strong consensus for a 25 basis point reduction in our policy rate. As I highlighted in the opening statement, this is our third consecutive policy rate. If the economy was significantly weaker, if inflationary pressures, if the downward pressure on inflation was significantly weaker than we expected, yes, it could be appropriate to take a bigger step, something bigger than 25 basis points.
He doesn't explicitly say 50 basis points, but he says more than 25. That would sort of imply a 50-point drop possibly. He does point out that he would consider this if the economy looks like it was in trouble. Now, BMO's chief economist, Douglas Porter, he's predicting that the central bank will continue these quarter-point cuts until mid-2025, potentially dropping rates then to 2.5%. On this topic, he said there is a case to be made that if the economy were to weaken further, there's little reason for the bank to keep rates in the neutral zone. Still, though, we're battling with those high shelter costs. This factors in high rent. It includes the mortgage payments that we've seen so much higher than we saw just a few years ago. That remains the biggest factor in keeping inflation above that 2% target. The Federal Reserve is setting up to announce its first interest rate cut in 4 years on Wednesday this week. The goal there obviously is to ease high borrowing costs and cool inflation. The big question this time around is whether they will opt for a smaller 25 basis point cut or whether they're going to go for 50 basis points. A lot of people are calling for that as well. As of this morning, the odds are just over 60% that the cut will be 50 basis points, with around 40% predicting a 25 basis point cut. In most camps here, people are feeling that any cut would be a positive step, but it doesn't mean that there will be this immediate relief for most Americans. Regardless of the size of the cut, any effects are really predicted to be pretty gradual. Greg McBride, he's from bankrate.com, and he says, what borrowers can be optimistic about is that we will see a series of rate cuts that cumulatively will have a meaningful impact on borrowing costs, but it will take time. Now, either 25, 50 basis points, it's not going to dramatically lower any costs right away. Interest rates, which are now in that range of 5.25% to 5.5%, they are predicted not to drop below 4% until mid-2025. When we think of credit card holders, these in particular, McBride says, won't see any immediate relief. He says the Fed has to do a lot of rate cutting just to get to 19%. And that's still quite a bit higher than we were just a few years ago. Meanwhile, if we think of mortgages, auto loan rates, we may see some modest improvements there, but at least immediately, that's not going to have a material effect on buying a house or paying off any significant debts. One thing we have to consider, though, as far as the federal rate is considered, are the political ramifications. The presidential election that's just around the corner, coming up early November, a bigger rate cut there could lead to these accusations of political interference. And even though the Fed operates independently from the government, even this perception of influence could take even a bigger role than they'd like between now and November. So we know that interest rates will be going down. It's just a matter of how much. With this as a backdrop, rate-sensitive Harvest ETFs, they hit 52-week highs in August. Further rate cuts could continue to benefit this lineup. I would like to mention 3 funds that would benefit from this. First off, the Harvest Equal Weight Global Utilities ETF. The ticker is HUTL. Utilities probably will benefit from rate cuts. That's due to the lower borrowing costs that they'll be faced. That brings in higher profitability, the potential for dividend growth. Also, the Harvest Global REIT Leaders Income ETF, HGR. REITs are highly sensitive to rates because they often carry large debt. The lower rates reduce the borrowing costs. They make real estate investments more attractive compared with fixed income. And thirdly here, the Harvest US Bank Leaders Income ETF, HUBL. In this type of company, the lower rates can compress those net interest margins. They can stimulate borrowing and economic activity. That benefits banks through increased loan growth and through financial transactions. You can learn more at Harvest ETFs. I will put a link for each of these funds in the description of this video. It's a head head-to-head battle this week on the poll question, is government intervention in labor disputes like Air Canada's justified? We have a really, really close vote so far. You can weigh in with your thoughts and visit our website to cast your vote. Again, I'll put a link in the description of the video. Both good news and bad news from the aviation sector this week. First off, the good news, Air Canada, they have reached a tentative agreement with the union that represents about 5,200 pilots, and that will avoid a strike, which would have begun this week. In just a few days before a potential disruption there, that will obviously come as a huge relief for passengers. It'll keep flights running while the union members vote on the deal. The deal does follow a year of negotiations where the pay was the key sticking point there. The Airline Pilots Association, ALPA, they had argued that Air Canada, despite its record profits that they've been seeing, was offering below market compensation. The union noted that about 25% of the pilots were actually taking second jobs, 80% of those out of necessity. Now, in response to that, Air Canada offered a 30% salary increase over 4 years, though the union initially found this insufficient. The tentative 4-year deal, that, if ratified, will add about $1.9 billion in value for the pilots. It will also address key issues like compensation, retirement, and work rules. Now, ALPA Chair Charlene Hudy, she says, the consistent engagement and unified determination of our pilots have been the catalyst for achieving this contract. So with this tentative deal in place here, for the time being at least, Air Canada and Air Canada Rouge, they will continue their normal operations. Key here, if you are a customer who has changed flights due to potential strike, you can revert those to the original booking, and the airline said there will be no cost for that. On that note, the deal did avert major disruptions. There's about 670 daily flights, over 110,000 passengers that fly every day, so we have good news there. And lastly here, union members are expected to vote on the deal in the next month, pending approval by Air Canada's board. Staying in aviation, but with the not so good part of things, it isn't good news at Boeing. Factory workers there, they are now on strike after they overwhelmingly rejected a proposed labor contract. The strike began at midnight on Friday. It's hitting production at Boeing's key manufacturing hubs in Seattle and Oregon. Now, workers voted 96% in favor of a strike, and then they rejected the proposed deal by 94.6%. The main concerns there, they have dissatisfaction with wage increases and cost of living adjustments. The tentative deal that was offered, it offered a 25% wage increase over a 4-year time period, along with healthcare and retirement benefit improvements, but the union had pushed for a 40% raise. They argued that the deal on the table didn't address the rising cost of inflation. IAM District 751 President John Holden, he accused Boeing of using unfair labor practices. He called for fairer negotiations. Boeing's CFO, Brian West, he said he was disappointed over the strike, warned it could delay airplane deliveries and disrupt production. He said there was a disconnect, and he says that Boeing is eager to negotiate a deal that works for everyone. He also added that Boeing's immediate focus would be on conserving cash as this strike unfolds. Another potential problem for Boeing is the fact that credit agencies have warned that a prolonged strike could lead to credit downgrades. Lastly on this story, but not insignificant, this strike is obviously a huge blow to Boeing's new CEO, Callie Ortberg. He just became president and CEO on August 8th this year. He had urged workers to avoid a strike, and he warned that it could hurt the company's recovering. But you can see how much impact that had on the workforce. Not much, obviously, there. The company's production issues, including supply shortages and manufacturing flaw, had already had an impact on deliveries. As an example, Southwest Airlines has already lowered its expectations for new Boeing planes for the balance of this year. Don't forget to vote on this week's poll question. Tomorrow, we have the inflation numbers coming out for Canada, and on Wednesday, the U.S. rate decision. I will be back with that news. As always, thank you so much for watching. We'll see you in the next video.